Hey guys, Whitney here. Thanks for joining today on this lovely Friday. I'm going to give it a minute or two while people file in the room. And we'll get all set up. For those of you who are joining live, if you would go ahead and find your Q&A box. I believe the chat box is disabled, but I would love to know your top burning question that you want me to answer in today's webinar live. Go ahead and drop that over in the Q&A box. Let's go ahead and make sure you know where it is. Let's find it. And also two, I can kind of help tailor today's webinar to get your burning questions answered for you. Also, go ahead and tell me where you're from, where you guys are joining from. That'd be excellent to know. All right. Woo, we got a full house. Amazing. Okay. Dallas, Texas. Awesome. Memphis. All right. Central and a little bit towards the east. Oh, Seattle. Excellent. I don't know if you guys got the same snowstorm we did here in Colorado, but we're a few inches under. Louisiana, Monroe. I used to live in New Orleans. That's amazing. DC. Okay. All over the place. Charleston. Yes. All right. I was just there a couple weeks ago. Somebody said burr, snow. Yes, it is very cold. We went from 75 degrees one day to 24 the next. That is a big drop. Awesome, Virginia, excellent. Also, thank you so much for telling me where you guys are from. I want you to go ahead and think of a question or what is the burning thing that you want me to answer in today's webinar, because we are going to cover a lot of ground. Awesome. Conifer, Colorado. Excellent. Yeah, you probably got the exact same snowstorm that we got. Awesome. Okay, well, I think we've got a quorum here. Everybody's here. I'm going to go ahead and let you guys know today's webinar is being recorded, so be sure to watch out for that recording link. Feel free to share this recording with somebody that you know that could benefit from passive investing. It maybe needs to boost their skills in this area, or just somebody who just needs to understand how powerful of an investment strategy this can be. But for those of you who don't know me, if this is your first time joining live, this is the Passive Investing Made Simple Bootcamp. Today, we are going to tackle vetting operators, markets, and deals. Here is my contact information. You guys have it. You can contact me at any point in time in multiple ways. If you aren't already on our web list, our Passive Investor Club, make sure to join that at passiveinvestingwithwhitney.com. You get some extra free goodies there. You can also jump on the phone with me and we can talk about all things real estate, but also what open deals that we have that might fit your portfolio before the end of the year. But let's go ahead and dive in. What I do in this bootcamp is to really help demystify myths around passive investing that keep investors sidelined. We're also going to learn how to properly vet operators, markets, and deals in today's webinar. Now, if you guys joined me for last week's masterclass, that was just a high-level screening process that I did with Taylor. Today, we're going to talk about, setting up your own, what are those questions, that repeatable process that you need to have in place for you to vet operators, markets, and deals, consistently. And so you can go into your next deal with confidence, right? That's what we're all wanting right now, is to know when we write that big check with an operator that we can confidently assure that we have, dotted our I's, crossed our T's, especially in today's environment. Okay, it's always a little nerve-wracking to write that check, but in today's environments, there's a lot of questions. All right, but I want to bust one of the biggest myths that investors have about passive investing is that they have no control. I hear that quite often, that investors just, I can't get into passive investing because I lose control over the asset. And that simply isn't true. All right, if you joined me in September's boot camp, we talked about setting your goals and you understanding what your risk factor what the risk profile is that you want to invest in. That's step one of maintaining control. Today, we're going to talk about those other 3 steps, because as a passive investor, you do have an immense amount of control. You know your goals, you know what risk tolerance you are willing or not willing to take. But more importantly, you get to choose who you invest with, where you invest in, and what deal you go into, especially if you're investing in small portfolios or single asset entities rather than funds. You get to maintain control over those 3 aspects. And the most important thing that you get to control is who you invest with. And I think this is the biggest mindset shift that passive investors need to make, especially if you're coming from stocks, bonds, and mutual fund investing, or managing your own real estate portfolio. It is not about the returns. Okay, the returns is a big chunk of the vetting process, but it's most important to vet who you are invested with, because a great operator can make or break a deal. Now, we're going to talk more about that in a minute. So this is the whole reason why I invest in real estate, but more importantly, passive real estate, is me and my crazy crew. I've got to update this photo. My baby girl here has grown up so much more. She looks like a little teenager rather than a youngster. But anyways, I started off real estate investing in 2002, living, flipping, and house hacking, and did a couple projects by myself, and then my husband joined me and what I call my antics there. And we did pretty well at building up buckets of equity, but what we didn't have was control over time, control over finances. We were still locked into those golden handcuffs of our job. And that's when we decided that we need to start holding on to some of these flips. And so we built up a passive real estate portfolio. And I'm going to talk about what passive means here in a minute, but we had over 30 single family properties, and we were still doing flipping on the side. Now, something happened. 2 things happened. 1, I was taking care of family members, but 2, we had a baby girl. And that's when I realized, man, time is incredibly precious and I need it back ASAP. And that's where we figured out that we needed to scale, and we could do it actively by managing our own assets, or we could do it passively, or we could do it both ways. And that's what we decided to do, was figure out which way, actively or passively, would help us scale our portfolio. Now, spoiler alert, we are so glad we did do a little bit of active investing. We needed to in order to build up our equity position. Just because we weren't bringing home, we're not high net income earners from our day job, but it was the passive investing passively that allowed us to scale further, faster, and get control over time much sooner. Now, again, I put these numbers on the screen. These are, we're actually at over 6,500 residential units and over 1,500 self-storage. We have car washes, hotels. Our portfolio has a wide diversification to it. But really what most people are after, what you're probably after here, is 100% control of your time, control or choice on how you spend your time. And that is what I'm going to help you do today by learning how to do the number 1 thing that you need to know how to do when it comes to passive investing, and that is vet operators, markets, and deals. Now, for those of you who are looking to build a portfolio, we can help you do that here at passiveinvesting.com. We've got, over 1.3 billion assets under management. That includes 3,300 multifamily units, 6,600 self-storage, 153 hotel keys, 16 car washes, soon to be 21. But really the value we drive for our investors is us being able to manage all that for you and deliver a return that's very beneficial to your portfolio. Now, we are going to dive into some deep topics today. Okay. None of what I say is financial advice, legal advice, tax advice. Okay. So make sure that you digest this. And if you need to consult with a team member, like a lawyer or a tax advisor or something like that before you invest, do so. Okay. I've seen that mistake happen with investors as well. They have watched a webinar about tax advice. They implemented it, and then all of a sudden, they're having to unwind because that tax advice actually didn't apply to their situation. All right. And again, here is a great way for you to get a hold of me. The QR code sometimes works, sometimes it doesn't. Still trying to troubleshoot that, but passiveinvestingwithwhitney.com is the best way to get a hold of me. We can hop on a one-on-one call there to discuss your goals. Now, here is today's agenda. Guys, this is a boot camp, all right? This isn't a masterclass where I'm delivering a bunch of information and then all the questions come in at the end. I want you finding that Q&A box and asking questions the entire time, okay? This is for you. We're gonna workshop here. Now, we're gonna do a little bit of recap, like a less than 5-minute recap of what we went over in September, and that is your goals and your risks, right? Because you do have to understand those. Those are two tangible things you can control. But where we're gonna spend our bulk of our time is in this part 2 arena, which is actual control, and that putting those systems together on how to vet operators, markets, and deals. Now, just looking at the Q&A box, there's a few people here that I know that are pretty new, that are not quite sure what passive investing is. What have I gotten myself into on this Friday day or morning, depending on what part of the United States you're in? I just want to take a quick moment and get everybody on the same page of what passive investing is and why it's so powerful. But first, we have to understand one of the tangible benefits of real estate is creating passive income. Now, the IRS considers passive, income passive, and it receives the highest tax break. So if you're earning rental income from either a rental that you own or in a passive syndication, it's considered passive. Now, that's one definition of passive. When we're talking about passive investing, we're actually talking about your time. We're not talking only about the money. We're talking about your time, because your time involvement is also passive in a syndication, leaving you the ultimate freedom to spend your number one resource how you want. Now, you guys go over to the Q&A box. If anybody here has single family homes, is your time passive? I still have single family homes, by the way. And I can tell you for myself, it's leverage. It's not exactly passive. I'm still working with the property managers. I'm still working with, like yesterday, I was renegotiating a property management contract. I'm still working with lenders. I'm still working with my tax accountant to figure out the best way to poise the business. Maybe I'm even having to jump on the phone with Home Depot in order to figure out a delivery problem on something. It's not exactly, 100% passive when you have your own controlled real estate. When we're talking about passive investing, it is completely hands off once you have done your due diligence and funded your investment. Now, there are a couple things that you do need to read the monthly updates. You do need to respond to any questions that the operator may be asking you, but it is truly passive with your time. All right. Now, the other thing that we also need to orient around are the 5 freedoms, okay? Because this is the result. When we get our time truly passive, and we're also earning income unhitched from our time, this is what opens up the door. This is the results that we can get from investing passively. We can get financial freedom. We can get time freedom. We can get location independence. We can get freedom of choice. And we can get to choose how we want to create an impact on the world, okay? Because the world is our oyster. Now, all right, definition. What is a syndication? All right, we've talked a little bit about passive investing, passive real estate, what that means. A syndication simply is, well, first of all, I know when I first heard of a syndication, I was like, ooh, mobs? A mob syndication? No, a syndication just really means a group of people coming together to achieve a goal. So in this case, it's a group of investors pulling their capital together to invest in a larger asset, like a multifamily asset, self-storage, car washes, hotels. It can even be real estate notes, right? It doesn't actually have to be an equity play. It can be a income play as well. But what that bringing that capital together, the active component of the syndication and the passive component of the syndication helps you create massive leverage. And you get to leverage the operator's knowledge of the strategy, the market, the underwriting, their expertise and track record, their team of brokers and property managers. You're not having to manage the property manager yourself anymore. You're not having to get lending, secure credit and lending. You're not having to go find other people's money or spend your time building up your own capital. But more importantly, you get back your time. All right. Somebody asked, what's the approximate length of this webinar? I have it on pace for us to finish in about an hour and a half. That's kind of like loose timing. We might finish up a little bit early, but again, you get that recording so you can watch it at your own pace later. All right, so September's recap. Know your goals, right? That's the first step. You need to know what you need from your portfolio before you actually ever invest in a deal. And I guess to even back that up even further, do you even believe in real estate, right? I think we're all here. We can check that box. Like if we didn't believe in real estate as, something that could produce wealth for us, produce financial freedom for us, we probably wouldn't be here. But what do you need from your portfolio? Okay, this is going to differ. This question is going to differ from everybody depending on their financial situation, where they are in their accumulation phase of their portfolio. Do you have no kids? Do you have kids? Are you retiring? These questions are all going to be different. But these are some of the things to consider here. Do you need capital preservation? Do you need cash flow? Do you need equity? Do you need pass-through tax benefits? Do you need some sort of additional leverage in your portfolio? You want to be able to take advantage of lending, but you can't get a loan yourself, or you don't want to take on that lending risk yourself. Do you need a diversification in your portfolio? Do you need some sort of inflation hedge in your portfolio? The other question related to your goals is, what is your investment timeline? Everybody has a different timeline, okay? Some people are like, I want to go in and out in 2 years. Other people are like, I want to asset and hold it for 10. We tend to like the sweet spot of about 5 years, and that's for a variety of reasons, but a large reason so we can create velocity with tax benefits, okay? And I'm going to do a webinar next Tuesday over depreciation. All things depreciation and how it benefits the passive investor. Make sure you sign up for that webinar because I'm going to demystify everything around depreciation, accelerated depreciation, bonus depreciation. I'm going to show you the math and how powerful it is for your portfolio. But what is your investment timeline? Okay, you need to know that because if you need to turn money around really quickly in a year, well, that's going to, be an entirely different set of investment options, as opposed to if you could invest in 5 to 7 years. And then you need to know your risk, right? Because you need to understand how also to mitigate loss of capital, suspension of distributions, and business plan risk within the portfolio. And a lot of what we're talking about today is going to speak to this business plan, or learning how to mitigate risk. But you need to make sure what risk you're willing to take actually align with your goals. So many times I get on a phone call with an investor, they're like, I want a 12% preferred return and I want 0 risk. Largely, that does not align, right? So you need to understand what type of risk you're willing to take in exchange for the return that you get. A question came in, is 7% preferred return still a good profit in multifamily syndication? Right now, yeah, but that doesn't necessarily speak to the risk of the asset. So there's a lot of questions that we can ask around that. Another question came in related to this section. How do you determine your goal should be cash flow or building equity? Great. I'm going to do a boot camp actually in December on how to, essentially like financial goal setting. So taking a look at your finances, that way you can tangibly build a number, not a budget, but like know what your financial freedom number is, or absolute freedom numbers are. But here's the thing, is most people are either trying to replace their income or they're trying to cover their expenses. And it's kind of a little bit of blend of both. And so I'm going to help you walk through a process to figure that out. Now, for me, I always look for assets that have cash flow and equity. I want to be able to flip that switch right now if I never wanted to work again, which means I need to have cash flow coming in now. And I'm still in the accumulation portion of my portfolio, which means I need to have back end equity to continue to grow my wealth. Now, a lot of people are like, I don't need the cash flow. Like, I'm going to go for all development assets, no cash flow. Well, I want to have that flexibility, because even though I don't need the cash flow now, I can always reinvest it into another deal. But I don't have the flexibility. If I don't have the cash flow, I don't have the flexibility to kind of flip that switch if I, whatever reason, wanted to like entirely step away from work. So this really depends on your goals and what you need. But sometimes if you can't decide, take both. All right. Now let's start getting into the control part. Okay, because again, I'm going to give you a ton of questions here for you to consider. So the best way to orient here is perhaps open up a Word document, or what I like doing, an Excel spreadsheet, okay, and taking down some of these questions and dropping them into these sheets. That way, when you're on the phone with an operator or you're reviewing their website, you can actually answer some of these questions immediately. And it gives you a standardized process as you talk operator to operator, so you can compare, contrast, right? Now, remember, we talked about the operator is, being the number one thing that helps us, actually excel in passive investing. But, we need to actually demystify what the word control means, right? Okay, so the verb control is a verb. Okay, it's the behavior or supervision of the running of acts. Okay, control doesn't mean that you mitigate all risk. It doesn't mean risk is completely eliminated from the equation. Now, I want you to think about what's in your portfolio right now. What kind of control do you have of these assets? All right, so think about it right now. You guys go to the chat box. I'm going to throw out some assets. What kind of control do you have over cash? What kind of control do you have over stocks, bonds, mutual funds? What kind of control do you have over your pet? What kind of control do you have over your kids? All right, jot it in the the Q&A box, because I want you to kind of help you guys walk through a process on the difference between mitigation and control, because this is really important for us. Can you control what happens in the stock market? Can you control what happens in the bond market? We got a lot of no's there. Nope, no on the stock market. Somebody asked, will there be a recording? Yes. Look for that in your inbox, probably like later today or tomorrow. No, you cannot control these things. You can't even control your dog. I have a pet. I have a new 10-month-old puppy. Like I can influence them. I can influence her, but I can't control her. Okay. Now, that control indicates that I can't, lock those things down. So what can I control? Well, I can control my decision around who I operate or who I invest with, where I invest, and what deal I go into, but I can't control the outcome of that particular investment. Okay. So that means, and when I say control who, where, and what, that means we actually have to have a good process in place to ask all the necessary questions. That way we feel good about that decision we made, because we can't actually physically control the outcome. So what we're trying to do here is risk mitigate. All right. So the number one rule of investing, according to Warren Buffett, is to not lose money. Second rule is to see rule number one. That's what we're trying to do here. Now, for those of you who are a little bit new to syndications, let's kind of understand what operators are. Okay. We use some of these terms interchangeably: operator, general partners. The general partners, sponsors, or operators, they handle the finding and conducting the due diligence on the asset. They purchase the asset. They complete all the daily maintenance and management of the asset. They'll handle all the lending and financing decisions. And they'll also handle all the sales decisions. They step into this active role, okay, in order to get a slice of the pie, return on the cash flow and equity. And it takes a village to run a deal. Okay, the general partner is bringing to the table brokers, lenders, construction, property managers, insurance, legal, tax, bookkeeping, possibly 1031 providers, and if it's a fund of fund, maybe even a fund administrator. Okay, they're bringing all this to the table so you, as the limited partner, can conduct due diligence on the information presented, fund your investment, and then respond to any GP request. You do this because you want to have a passive role in the deal to get your time back and also share in the profits. Okay. So why does this work? GP is good at deal flow, the ability, and they have the desire to manage the deal. They got the time, the people, the systems, lending, credit, but they need capital. The LP has capital to place in a deal, but they don't have the deal flow or the ability or the desire to manage the deal. Okay. Maybe they have the desire, but they don't have the people, the systems, the lending, the credit to make it happen. So that's why this whole system works. Okay. So hopefully that helps you demystify who general partners, operators, sponsors are, and how their role differs from the limited partner, which is you, the investor. Now, here's some of our questions. Okay. I think of it this way. When I'm interviewing an operator, I'm interviewing somebody to be the COO, Chief Operating Officer of my real estate business or investment. So I need to take that hat off, or put that hat on, a CEO hat on. And as a CEO, if I'm going to have them run my business on my behalf, what kind of questions? Okay, who do I need in that role? Who do I need in that position? Okay, so for one, I first need to understand, do I know, like, and trust them? Okay, do they seem genuine? Do they seem authentic? Are they transparent? Are they honest? All right. I come from a public health background, a medical background, and I could spend a whole webinar on health and how your gut plays in your decision making, but we do need to pay attention to our gut. What kind of feeling are we getting from our gut? Okay, it's going to inform a lot for us. Okay, once we're kind of like, okay, cool, I want to know this person further. I want to get to know them. I think they can be a good person to work with. Now I need to get down to brass tacks and actually figure out if that is the case. So I want to know what their background is. What kind of background do they have in real estate or business or both? Okay. How many, real estate cycles have they been through? Okay. What was their experience? How did they navigate that? How many syndications have they done? How many deals have they taken full cycle? Okay. We've taken 8 full cycle and we're very proud of that. Okay. Once I understand them, I want to understand if they are operating as a solo operator, or do they actually have a team built out around them? And who is that team? Who's on their team? What's their skill level? What's their role? Okay. This is these are my 2 favorite questions, because a lot of times you find yourselves, people calling themselves operators, and they're really not. They're a capital raiser. Now, not knocking capital raisers at all. There's a time and a place for that. And it might be, for some, it might be a good decision to invest with the capital raiser. But this is kind of a way to kind of tease that out. Okay. If they are actually an operator, actually a sponsor of a deal, or if they're actually, a co-sponsor or a capital raiser. Now, there's a role in it for everybody. But for me, I want to be as close to the deal operations as I possibly can. So I personally look for, sponsor or operators that are direct sponsors. They're actually buying the deal. They own the deal. Who's managing the asset? That's another kind of question to kind of tease apart what their relationship is to the asset. Are they management? Do they oversee the day-to-day operations? Or are they a co-GP and they're co-managing the asset and maybe only sit in an asset management call, every couple months or once a quarter, right? What is their level of involvement? You want to tease that out as well. What is their typical investment strategy, right? This is a great question to get at if what the operator offers is going to align with your goals, okay? Do they like investing for cash flow? force equity on a deal? Do they like flipping deals? Do they like buy and hold deals? Okay. How does that line up with your goals? I also love asking this question. What are the major risks of the investment strategy? Okay. The reason why I love asking that question is I want them to give me more information than what the standard SEC requires. I want to understand if they actually have done a SWOT analysis on their business. Do they understand the strengths, the weaknesses, the opportunity, and most importantly, the threats to their business? Also along the lines right now, especially in this environment, what kind of lending are you using to close your assets? Okay. Now, you're going to get more information on this on the deal stage, but even asking that question right now is going to help you, again, start teasing apart some of this business risk. Okay. Do they like using construction debt? Okay. They're using short-term debt and they're going to refinance out and, and try to get another loan here in 12 to 24 months, or are they putting fixed rate debt on the deal? Or they have some sort of hybrid process where they are getting a fixed rate, or using some sort of floating rate debt, but they've capped it, or they've added extensions. Understand what is their communication plan and the K1 plan. Okay. Do they do monthly communication? Do they give out financials? What type of reporting do you get to see? Okay. This gives you an understanding of what level of a partner you are truly going to be treated as. K1s. When can you expect your K1? A lot of people here, I'm sure, are looking to get their K1s by, early April so they can file their taxes for April 15th. Sometimes that we aim to do that for sure. And, the past couple of years has been a little tricky, making sure to get that done, especially with the tax deadlines moving around and stuff like that. But that is a great question to ask. That gives you a kind of a clue into the business. Are you, the retail investor, very important in their business, or is their business more geared towards institutional investing? Because if it's geared more towards institutional investing, they may say their K1s aren't going to come out until August, right? Because institutions don't need it until October 15th. I love this question. Have they ever had an investment go sideways? Now, you're not looking for perfection here. For me, I'm looking for somebody who can take lemons and make lemonade, right? I'm looking for somebody who has taken some hard knocks and has persevered through that, has shown resilience, okay? Somebody that has had zero issues through COVID, I don't know, may not be well poised for, any upcoming challenges. Now, we all have to get started somewhere, okay? But, if they don't have it in real estate, do they have it in some other business adventure that they can bring that resiliency in? You're trying to dig at, can they handle the rolling with the punches and make investment decisions on your behalf? And then also at this stage, you can actually ask what their typical waterfall fees and if they have any catch-ups looks like. What is their typical structure on their deal looks like? Now, what you probably will get in response to this question is investment summaries to take a look at, because if they offer different types of assets, or if they work with different actual direct operators, they're going to have different structures for their deals. But that is a great question to ask for right now, because that's going to clue into the business risk, and you're going to want to know those up front, right? Do you want to continue right now? What you're trying to figure out, do I want to continue a relationship with this operator and potentially invest in a deal with them? Now, how do you find these? Oh, hold on. Before I go into how to find these operators, let's talk about some red flags. If I'm having this conversation with the operator, or if I've gone through their website information and then had a conversation with them, there are some red flags here that kind of maybe don't, keep me from investing necessarily, but, make me, definitely question what is going on. And do I need to dig further? One, is there only one partner? And there's only one partner. That might be a little bit challenging. Like, heaven forbid something happened to that partner. What is the succession plan? What would happen to your investment? Again, you would need to ask further to understand, like, do they have somebody, would your relationship revert back to the operator? What would happen with your relationship? What would happen with your investment if something unfortunate happened to that partner? Are they full-time in their business? Or are they trying to work a full-time job on the side and then do, syndications? For me, I like having somebody full-time in the business watching over my funds. Do they have a track record? Okay. If they don't have a track record in real estate, who on their team has it? Do they have a strategic partner they can bring in? Do they have a business track record that translates really well, right? I want to dig further on that and really fully understand, where's their street cred coming from? Are they an active participant in the deal? Okay, again, this alludes to, I'm trying to figure out if they, what their relationship is to the operator and how well they can speak on behalf of their investors and make decisions. Do they have a full-time operations team, and what's their track record? Okay, do they have people working with them and helping them manage the day-to-day asset on your behalf? Are they co-investing with the deal? Now, a lot of people just starting out might not be able to, have the funds to co-invest on every single deal. I want to get to the bottom of that question and understand why. Okay, so co-investment, for me doesn't rule somebody in, and it doesn't necessarily rule somebody out, but I want to know what is going on there. I'm just going to check the chat questions box right now. There was a question that came in. Every operator says they buy into deals with great IRRs, easy to execute business plan, and minimum risk. So how do I differentiate? We are going to answer that in the deal section. So stay tuned for that. Okay. All right. Now, where do you find these operators? Number one way is to ask other seasoned investors who they invest with. Okay. Next, go to high-level conferences. Okay. I like the Multifamily Investor Nation Conference. We put that on in June in Charlotte, North Carolina, 12th through the 14th. Okay. If you're interested in going, let me know. You can email me at whitney@passiveinvesting.com, and I can, shoot you probably a promo code to get a discount on that. Another conference is Best Ever, and this year it's going to be in Salt Lake City. That's another, conference that could be a good one to go to. Go to high-level conferences. Okay, you not only get to meet other like-minded investors, but you'll get to meet operators as well. You could join an investment group. Okay, there are, check your local area and see if there's a local investment group. And I'm not talking about just like a meetup of where investors are coming together. I'm talking about an actual investment group where investors are vetting deals together and bringing operators to present into the group. Number 4, another idea is to do a Google search. Now, this makes your vetting process even more important, because now you got to discern who has just great marketing versus who are the actual players in the space. But a Google search can, yield a wealth of results for you to start with. But no matter what, even if you got a referral from another investor, make sure you go take that operator through your own due diligence before you invest with them. I can't, tell you how many times I've seen investors get in trouble, or stories, from some of my investor friends that were like, well, so-and-so recommended them, and, the deal went south, or the deal went sideways, or I'm not happy. Recommendations are great, and do your own due diligence. All right, so to sum up this section right here, again, I'll flip back to that slide because I want to encourage you guys to take screenshots here as you build out your process. But remember, keep a spreadsheet. If you're not already doing it right now, do it immediately after today's presentation. And in that spreadsheet, you're going to keep a list of operators. Okay, you're going to have your questions. You're going to keep a list of operators so you know who you talk to, and you can rule them in and rule them out. If you're ruling them out, get them out of your inbox. Okay, declutter your inbox. You don't need to hold on to that operator's emails. You're going to screen that operator against the criteria that you've outlined. Okay, now you use some of those questions, add ones of your own. Now, if you can't, if you screen them, gone through their website and, various materials, maybe listen to some podcast, make sure you are scheduling time to talk with them before you actually place an investment so you can get your deeper questions answered. Take copious notes. Because if you're in the beginning phases of sourcing your operators, you're probably going to talk to 10, 15, 20 or more operators. Take notes so you're not confused. Don't try to keep it all in your head is what I'm trying to say. And make sure to ask follow-up questions. A lot of operators, they'll jump on the phone with you for like 15 to 30 minutes. They give you an email package as a follow-up package. That's not done. Your due diligence on the operator is not done. Ask questions, review that information, ask questions. The operator should welcome hearing from you on deeper questions. I know I do. I want all of our limited partners to be extremely well informed and comfortable before they invest in any asset with us. So I'm going to do you guys a quick solid. I'm going to jump back to the questions here for operators. Take a screenshot here. So you have those as you build out your list. I'm going to answer a couple questions here in the chat before we lose them. Do you share the results of your deals that have gone full cycle? Yes, those are in our offering memorandums. If you want, email me at whitney@passiveinvesting.com and I will share those results for you. High level, we've exited 8 multifamily deals, 3 years or less, generated over a 29% ARR on all of those deals, 26% LP IRR, and a 56% increase of valuation across those deals. But you can see individual performance. When you email me, I can send you that information. Awesome. We were able to sneak one question in there. Okay. Kind of a follow-up question came in here. How do you verify an operator's answers? We are going to talk about that because as you work through the marketing materials as well as the deal materials, you're going to want to verify. That's why it's great to take copious notes. You're going to want to verify what was in that original conversation with the operator. Now, keep in mind, business plans do change, but I guess what I'm trying to say is if they presented a deal structure to you in their initial one-on-one conversation, make sure you're double checking that due diligence in the actual deal to make sure that that is correct before you invest. Okay. Another way you can verify is maybe ask to see if they have anybody that you can talk to, previous investors, and get their kind of experience. Now, when you ask for recommendations, you're probably not going to get, you're going to get connected with investors that have had a great experience, but you can dig deeper on some of those questions with them. Also, those investment groups are a really great asset because that's where the investors are talking with each other about operators, and you can get a good feel for how operators have treated other investors there. All right, I'm going to take a quick sip of tea here. All right, let's get into vetting the market. Now, this is before we move on to operators, I'm just reading this. What are the double asterisks referring to in your presentation? That's mostly notes to myself to make sure that I'm pointing out something that's not on the screen. So my own notation, sorry if that's confusing. Another question came in, are operators really going to provide other investors information? They're going to approach, or at least this is how we do it. We have some investors that have already volunteered to be referral sources for us. So we have gained the permission to share their contact information up front. If it's a specific situation and we want to approach another investor because maybe there's a better connection with somebody else and we don't have their already blanket permission, we're going to approach that investor first and say, hey, we have somebody that would like to talk to you. Are you okay with that before we connect them? But yeah, that's what we're going to do. Yeah, you're more than welcome. Happy to answer these questions. That's what we're here for. That's the beauty of the boot camp, You get to spend longer time with each other and get your questions answered. All right, now vetting the market, okay? You can also ask the operator, during this 15-30-minute call, like what markets they're in. Now, they may, here's my kind of flow breakdown, if you will, right? In that kind of 15-30-minute conversation, you want to get a good sense of who they are, what they're doing, and at a high level, what they're offering, okay? That's probably not a long enough call for them to walk you through every single deal they have open and the metrics and all that, okay? That might be a follow-up call. So make sure that you have asked for what you need. If you're gonna ask for referrals, ask for the referrals, and ask for follow-up information on certain investments you're interested in. That's a great way to make use of time. That way you can really get to know, love, and trust the operator, because that's what you're trying to vet the operator in that call. You're not trying to vet the deal in that initial call. You're vetting the operator. That's the point. And I see investors sometimes spending that time to try to vet a deal. And then when they go into the deal, now they're trying to go back and vet the operator, okay? Take the time, ahead of time, spend that initial call, vet the operator, gather as much information as you can, review it. Okay, part of this review is going to be markets. That way, when you get to the deal, you can now, if you need to schedule more time to talk about a deal, you can. All right. Now, markets. All right. Now, when you get a deal from an operator, you're probably going to get a pretty package called an offering memorandum. And in there, you're going to have a lot of information over the particular market that asset is in. That is fantastic. Always double check that information, okay? Because remember, you're investing in a private equity placement. It is a illiquid asset. There is no second share, market share to sell your shares. So this doesn't have to be a scary process either. What you're double checking for is criteria at the MSA or sub-market level, and then also digging into a couple things at the local level, okay, definitely at the sub-market level. But I personally love, and my investment strategy is I like looking for MSAs where the population's growing, jobs are present, jobs are diversified, income growth is present, crime rates are coming down, poverty is coming down. Those tell me that there's a lot of investment probably coming into this area, and there's probably going to be a lot of supply and demand coming into this area. Okay, I want to look for markets that are trending up, not markets that are trending down. Okay, so a lot of this information should be in the offering memorandum. It won't take you that long to do a quick little peek to double confirm that is correct. I'm going to show you how to do that on the next slide. Now, the last two here that I would check at the MSA and sub-market level are looking for, especially if you're going to go into mobile home parks or multifamily real estate, anything with a landlord-tenant relationship. I personally love being in areas that are landlord-friendly states because it gives the operator a wide flexibility on how they're going to work with the tenant, as opposed to kind of a one-size-fits-all solution. Okay, and that can actually help protect your investment. Also, I like being in investments in areas where there's favorable tax laws. Okay, taxes, we're going to talk about depreciation and taxes on Tuesday's masterclass. Taxes are one of the largest expenses to an investment. So we want to make sure that there's favorable tax laws, where that asset's being held. Now, we want to check that at the MSA level, okay? When I mean MSA, like, let's say, Charlotte, North Carolina. And then we want to talk about it in the sub-market level, that particular neighborhood area of where the asset is, okay? We can double check all these measures at both areas. I'm going to show you a quick little way on, or point out some resources on how to do this. But when we go down to double check these criteria at the sub-market level, there's two other things that we want to add in here. We want to check supply demand, okay? This can be just a simple little Google search of, like, how many construction licenses and permits have been issued. How many people are expected to move into the area over the next 3 to 5 years. We want to make sure that there's actually going to be demand coming in and that the supply right now is low. And then location. Okay, sorry, I don't know who it was. I think it might have been Jeff. What do the little double asterisks mean? Okay, this is a great example. For me, when I talk about location, in this particular aspect, I'm questioning, is it on the right street corner? If we're talking about our car wash deals, you know, we actually we get down to traffic count. We get down to, are they on the right side of the street and have a good traffic pattern for them to turn into? Like that can even be part of the due diligence. You know, same thing with self-storage. We want to make sure that there's good traffic count as well. So there's some other things at the sub-market level that we want to check into. So these are some great criteria overall for any investment. And then, you know, you might need to, depending if it's like self-storage, car washes, add a couple other smaller criteria at that local level. All right, but how do we actually perform the research on this? Well, one, let's review the offering memorandum, and there should be data in there, but we want to make sure that data has come from a reputable source. CoStar, Marcus & Millichap, CBRE reports, and that's current. It's 2022, there's probably 2020 data out. Data generally trends 2 years in arrears, okay? If somebody's using a data set from 2017, I have questions on that. Now, you can also review public market reports. Like, you know, again, you can pull these same market reports that might be referred to in the offering memorandum. Marcus & Millichap, CBRE, Colliers is another good one. You can, but really quick and dirty way is to put in that market and sub-market into two websites, citydata.gov or niche.com. Either one of them, they pulled it from the same data set. Niche.com tends to be a lot more visually friendly, I would say, but that can kind of give you some color coding like B+, A area, you know, A+ schools, right? You can actually kind of just do like a quick and dirty little analysis and understand what's happening in that metro and sub-market area. Now, if you find any holes in the data, okay, don't immediately assume that there's an issue. Ask the operator, always ask questions, okay, you know, and see, you know, what they're able to provide. Can they pull a CoStar report to show you those market trends? That's a great question that sometimes I ask if I see holes in the data. All right, I'm going to take a quick drink. I'm going to clean up some questions in the chat box, but you know, if you have any additional questions over market research, let me know that. But market research is probably the quickest thing to do as far as vetting. And then we're going to get into the deal vetting. Some questions here. What's the investment conference in Salt Lake City? The two that I mentioned, MFIN, Multifamily Investor Nation, that's in Charlotte in June. And then Salt Lake City, the Best Ever Conference, that's another one that can be a really high quality conference. Average home prices in the vicinity of the property. That's a great criteria to add to the list. That list is not exhaustive, but that is something, especially if you're looking at multifamily or looking to, you know, to invest in build to rent communities, that can be a great criteria to add in there. Household income, you know, can be another great criteria. I just put it as like income growing, but you know, you want to look at the household income. I had somebody comment, this is a lot of information to check. To pick a stock, an investor simply needs to look at the company earnings. Yes and no. Again, this is about control. You know, when we invest in stocks, bonds, and mutual funds, we don't have any control. Okay, I had somebody mention earlier is I can actually just cash out, you know, sell any point in time that I want to. Fantastic, but you have zero control on that stock, bonds, and mutual funds. You're getting lag data. We're trying to look at the lead data and take control. Stocks, bonds, and mutual funds, you know, generally only have one or maybe two pillars of wealth to them. Real estate has 7. Okay, so this is the top asset. Don't let me convince you of that, but make sure that you're doing due diligence on how money is actually made in real estate and compared to stocks, bonds, and mutual funds, and and you'll probably be shocked that how little control you actually have of building wealth in real estate. So when I finally did all that, I'm a numbers person, and when I finally did a side-by-side spreadsheet, I was like, ooh, yeah, broke up with the IRS and liquidated most of my stocks, got into something that I can actually tangibly control and perform due diligence on myself. So but some people like stocks. That's totally fine. I'm not trying to convince anybody not to invest in any stocks. That's just more of a momentum type of investment. I equate it to more equity growth type investing as opposed to a more balanced approach. All right, let's see. Is there any regulation that prevents operators from sugarcoating data in their offering material? I don't know of any. However, an operator who sugarcoats data won't be in business long. The word on the street will get out. And yeah. Those operators tend not to last long. Unfortunately, what happens to those people who did invest with them before realizing that. So again, that's why, this is about putting me helping you understand and how to put control in here for you. I actually had and I know this particular investor is probably going to watch the webinar afterwards, but it was an amazing conversation because the investor sent me some questions and said, okay, here are my due diligence questions. When are you going to, our distributions monthly? How much can I expect to get? There was just a lot of things in there around cash flow, and the lacking questions in there were the due diligence, the underlying questions were like, how are you going to produce the cash flow? How are you going to protect the investment? What kind of operational reserves are here? What's the business plan? So again, I'm trying to help people to get past the screening questions into actual true due diligence. Not every investor is going to ask all these questions of an operator and do this process. I guarantee it. But for those of you who want to have more confidence when you do go into an investment, putting together this process, it might be a heavy lift, at the very beginning, but it's repeatable and you'll learn to execute really quickly moving forward. It's how my first year, I think I did 3 passive investments, and then I've gotten up to being able to do 15 or 20 years after, because I have a repeatable process in place that allows me to motor through and suss out great operators, markets, and deals. All right, so let's get into vetting the deal, because I'm sure this is where a lot of people have questions. Now, there are a lot of terms that I'm going to go over here, and I'm not going to have time to demystify each one of the terms or give definitions. Now, over here on our YouTube channel, you go to Passive Investing capital.com. I have videos up here that demystify each one of these terms. Okay, so that's a great place to go learn terminology. But you're going to hear about all these terms here as we go through here. And if you have any questions afterwards, let me know. Okay. So, how about this? These are the questions the investor sent me. What is the impref? What is the equity multiple in the deal in 5 years? When do you start distributions? Are they monthly? What can I expect from a monthly return? And have you ever suspended distributions? You guys go to the chat box. Is this due diligence or not? I want to know. Does this actually tell you anything about the asset? Okay, we got yeses, we got nos, we got some emphatic nos. Not sufficient. You know what, Joel, I love your answer. I would agree with you. This is not sufficient due diligence. These are great screening questions on a deal. You might have these initially in your purview, and if it doesn't kind of hit these boxes and according to your goals, then you might pass. But you need to dig deeper to understand how these metrics and how the cash flow is being supported. So I love it, Joel. I think you hit it right on the head. Is this due diligence? If it is, it's not sufficient. So thank you for that. All right. So we already talked about how to screen a deal last Tuesday's masterclass, but these are kind of high level things. So here's I have a process. I have a multi-phase process. When an offering memorandum hits my inbox, I'm going to look at it according to my goals in under 10 minutes and kind of rule it in, rule it out. Is it the type of deal I want to go into? Am I looking for multifamily? Am I looking for self-storage? Am I looking for car washes? Am I looking for hotels? Okay. If it's not the type of deal that I'm looking for, I might look through it a little bit more, but I might set it aside. Is it in the location I want to be in? Because just as your investment's illiquid, you can't move a property. Okay. A great looking building in the wrong area just won't perform. Okay. So you want to make sure it's in a well-suited market. And these are in no particular order, but I look at the cap rate. Okay. What is the entrance cap rate on this particular property? I want to know the entrance and the exit, but I'm going to take note of the cap rate. I'm going to take a look at the high level business plan. Is it the type of risk I want to take on? Okay. Is it a core asset where there's, no CapEx, no maintenance? I might achieve a little bit of lower return on that asset, but it shouldn't have any surprises. Or is it more of a development type deal, where there could be a lot of business plan risk, but maybe I should be getting rewarded for taking on this business plan risk as well. I'm going to take a quick peek at the pro forma. I'm going to see how the pro stacks up to the previous 12 months. I'm going to take a look at the loan structure, see what kind of lending is, in place here. Is it fixed rate debt? Is it, floating rate debt, but with a cap on it? No, those are things I'm looking for right now. What does the capital stack look like? Where am I as the LP investor in the capital stack? Am I right behind the senior debt, or am I multiple levels down? Okay. And then I'm going to take a high level, look at the sensitivity and returns and see if they kind of are in my box. All right. Now that 10-minute screening, this is where 90% of investors, okay, I'll give it, maybe 85% of investors actually stop. Okay. That is, again, not to borrow Joel's words, not sufficient due diligence, but this is better than a lot of people what they do. Okay, but what we're talking about next is going to be actual due diligence. Okay, having a screening process, having a due diligence process saves you time, saves you headache, saves you heartache. Okay, in that pre-screening that we talked about, make sure the deal again matches your goals, matches your risk, and is already you're getting it from a vetted operator. Okay, somebody that you've already talked to. Okay. Again, if you are looking at a deal and then realize you've never talked to the operator, you're doing things out of order. Because remember, the deal isn't what makes you money, it's the operator that makes you money. Okay, once I can say, I want to dig further on this. This looks really interesting in my screening. Now I'm going to go through a vetting process. Okay, I'm going to literally have my spreadsheet. Okay, and I'm going to start grading this asset. Is the market a growth market? I'm going to give it A, B, or C. Okay, and I'm going to have it in multiple columns, and a column for A, a column for B, a column for C. Is the unit count, is it a scalable unit count? Okay, now, here 100 plus units, that's going to be great, criteria for multifamily property, maybe for a self-storage property as well, but does it have multiple units of cash flow? And the reason why I like higher unit counts is because the operator can hire full-time employees to help manage the property. If it's a lower unit count, say in multifamily 40 or 50 units, they can't hire full-time employees to manage the property. They're probably going to be, having to rely full-time on property, off-site property management, not on-site property management. What kind of class is it, right? Right now in this particular market, I'm loving the A class properties, B plus properties, very little CapEx, deferred maintenance. I'm not getting any sort of, especially in the multifamily front, construction, timelines, labor issues right now. But the market might change and I might, switch up my classes, either to create diversification in my portfolio or to capture an opportunity. What's the hold time of the asset? Does it meet my buy box, my investment box for a hold time? For multifamily self-storage, I like 5 years, right? For a variety of reasons. One, it's a good amount of time to acquire a property, reposition it, and then stabilize it for sale. Okay. Also, if you're selling properties about every 5 years, you're capitalizing on accelerated depreciation and creating all those buckets of losses for your portfolio to keep your income tax-free. Okay. That's another reason why that 5-year timeline is such a sweet spot. Some people need shorter timelines. Some people want longer timelines. Are the returns, okay, at high level? What are the returns? Okay, now remember, returns are going to differ depending on what type of asset you invest in, what class of asset you invest in, and what the business plan actually is. All right. Does it have multiple pillars for building wealth? Okay, I say that because unlike stocks, bonds, and mutual funds, real estate generates wealth with cash flow, equity, tax benefits, the ability to use leverage from the banks to amplify returns, but also it creates an inflation hedge risk because we can adjust leases on an annual base with multifamily, a monthly base with self-storage, a daily base with hotels and car washes. And what's the distribution schedule? This is really important too. Depending on where you are in life, if you're, full-time job and you don't have need for cash flow right now, maybe you're okay with quarterly or biannually income. If you're trying to live off your, passive income, you're probably going to be happier with monthly income because it actually fits your lifestyle better. It can also give you a little bit of indication on how well the business is being run and looked after. Monthly income means that operator is looking at the financials on a very regular basis and able to run a tight ship to where they can distribute on a monthly basis. Now, once I have those questions answered, now I'm going to start attacking, does the deal match the business plan I want to be in? And what I'm looking for here is, how is income being produced on the property? How is the net operating income going to be bolstered and raised on the property? How is the operator going to increase income? How are they going to decrease expenses? And how are they going to add additional streams of income? Now, this is probably going to be in a paragraph on the offer, somewhere in the offering memorandum. It might even be in the investment webinar. Okay, but I want to understand how many net operating income levers or expected gross income levers that operator is pulling. Okay, on the pro forma, I want to take a quick peek and see what kind of income growth they're projecting and vacancy rate they're projecting. Is it reasonable? Is it conservative? Okay. I've seen some pro formas lately where the income growth is 10 to 15% year over year, and the vacancy rate is 3% year over year. Vacancy can be, physical vacancy might be 3%, but economic vacancy in a potential recession is probably not 3%. It's probably double that. It might be a little bit higher. I want to see conservative underwriting in that. I want to make sure, I would rather the operator under promise and over deliver in those areas. I want to also see the operator, do they know the area? Have they looked at both sales and rental comps? For rental comps, I want to make sure there are other properties that are achieving higher rents than what that particular the subject property is. It gives wiggle room. One, it demonstrates that if we achieve the business plan, there's room to go up. But also if the market kind of flat lines or faults a little bit, the rents can be dropped to be more competitive and pull people away from those higher income properties or more costly properties. And also the sales comps. I want to make sure there's room for growth in that aspect as well. And then sensitivity range. I'm going to show you a sensitivity range. But the three things I'm looking for here is the reversion cap rate. When they look at the reversion cap, the operator looks at the reversion cap rate. What does the IRR and equity multiple range look like? And then I want to look at the break-even occupancy. Okay. Now for multifamily, it's called break-even occupancy. Self-storage, car washes, it's going to be, your OpEx. Where's your break-even OpEx? Okay. But I'm looking to see like how low is that number? Because, if I can be at 95% occupancy, but my break-even or operational expenditure break-even is like 55, 60%. That gives me a historic range for things to move, and still that operator be able to have enough income to cover all the expenses on the asset. All right, I'm gonna take a quick moment and clear some of the chat box here and see what questions we got in there. Okay. All right. So take a big breath. We're going to talk about returns and sensitivity here. Now, the reason why I say take a big breath, because if this is the first time you're being exposed to this, you might go, what? Don't worry about this. Remember, I've got those videos up on passiveinvesting.com to help you. All right. Now, when we're talking about returns and we're looking at a deal, we want to, again, line this with our goals. We want to know what the preferred return is on a deal. Now, the preferred return is not a return. It's a hurdle for the operator to hit so they can start splitting income with the limited partner. So a preferred return just means X percent goes to the limited partner. In this case, in this particular deal, I pulled this from our most recent multifamily deal that's open right now, the Banks at Bridgewater in Myrtle Beach, South Carolina. And this is my example throughout, but in this particular deal, it's a 7% preferred return to investors. That's hurdle one. Hurdle two is actually the next, once that hurdle's been cleared on the cash flow, then it's 70-30 split, limited partner, general partner. Now on the membership, when that asset sells, it'll be 70-30, or the limited partner will get 70% to 13% IRR, and then the limited partner and general partner will split 50-50 after. All right. So, but that doesn't give you any indication on what the cash flow of the asset actually is. Okay. Preferred return is not a return at all. Remember, it's a hurdle. And this is a blanket statement across all operators. And I really wish operators would be more transparent about this. What you want to know is to look at the cash on cash, right? If you're trying to live off of cash flow, what does my cash flow look like year over year? Okay. So this is based on a $100,000 investment. Year one is a 5.1%. You might go, Whitney, that's not 7. What happened to the extra 1.9%? Well, for us, the way we structure our deals, it's a cumulative return. So you want to make sure that you know what your operator is telling you on that pref. Is it a cumulative return, or does it just go away if they miss it? All right, but we're showing you year over year. Now, what happens when that cumulative return isn't hit in the year? Well, for us, because it's cumulative, it gets paid out upon the sale of the asset. Okay, so it doesn't go away, it just suspends. Okay, but every operator is different, so you want to make sure you're asking these questions. Now, we talked about the pref, we've talked about cash on cash and what the difference is between the two. But a lot of people might be going, what's the IRR, the equity multiple? Okay, the internal rate of return and the equity multiple. Now, this was not shown there. We're going to get this information from the sensitivity analysis. And first, let's define what a sensitivity analysis is, and I'm going to show you one. If you don't see one in an offering memorandum, that should be a top #1 question that you get answered by the operator. Okay, you want to know one, did they do it? And two, that they need to share it. So a sensitivity analysis just takes into account several factors that might impact the investment's returns and helps you calculate how a change in each one of those factors will affect your profits. So why is it important that you get visibility into the sensitivity analysis? And it's because the IRR and the equity multiple can be manipulated. So you want to make sure that you are looking at pro formas that have conservative rent increases, conservative vacancy, conservative business plan and timelines. And if those criteria have been met, then you can be pretty confident what they're showing you is in the sensitivity analysis is going to be the type of returns you can expect from the asset. Okay, let me say this another way. If you're looking at an offering memorandum that has really aggressive, outstanding rent increases, absurd vacancy, low vacancy, has not taken into account any sort of business plan hiccups that might happen, that sensitivity analysis they showed you might be severely aggressive. Okay, so hopefully me phrasing it the two ways will help you out as far as what you should be looking for. So this is what a sensitivity analysis looks like. Okay, essentially what we're doing here is showing you what happens when the cap rate expands, okay, meaning the market is getting worse, okay, or softening, and what that does to the internal rate of return, the equity multiple, and the cash on cash. Now the cash on cash shouldn't change, you know, if the operator has done their job, but the net operating income might change. Okay, and the net operating income, or excuse me, if the returns on disposition might change, and if the cap rate changes, the value changes. Okay, so here in this particular asset, we're entering at a 4.2% cap rate. Now we're all happy if the market gets better and cap rates continue to compress. You know, we're going to have higher IRRs, higher equity multiples. But realistically, you know, I wish you guys could raise your hand, but go to the chat box. Do you think the market is going to soften or get better in the next 24, 36, you know, 48 months? Put it in the chat box. My question is, do you know? Do you know for sure? And the thing is, you don't. So what would I rather look like? I would rather look at somebody showing me what would happen if the market softens, with hopes that it goes the other direction. Okay, so here, this is what a sensitivity analysis looks like. Okay, so that got us through screening, our phase 1, phase 2 of analysis. Now phase 3, if I'm still liking what I'm seeing here, I'm going to go into phase 3 and just double check that the business plan can actually be sustainable. One, you know, what's the safety of the asset? Do they have enough reserves in place? Now, the bank's going to require reserves to be carried, but is the operator carrying additional reserves? Are the reserves being invested? If they are, where? Okay, are they just sitting in the bank, or are they being invested in some sort of fund? If they are, where? You want to know that. Lending, okay, you know, I'm looking for lower LTV, okay, you know, 70-75% loan to value or less. Okay, I want it to be non-recourse if possible. I want it to be fixed rate. If it's not fixed rate, if it's a floating rate, is there a rate cap? Interest only for the term of the hold. You know, especially if the intent is to sell an asset, interest only loans are perfectly fine. Okay, you don't want to have additional equity trapped in the asset. Okay, is there ability on the loan to purchase extensions and continue that rate? Okay, and then again, that lending piece, what is the break-even or break-even operational expenditure in order to cover all expenses on the asset, including the leverage? Okay, you're going to want to understand what the fees are on the asset. Now, sometimes you can't actually get visibility on the fees until you look at the private placement memorandum, but you can always ask. So now fees, there are like 8 different types of fees that an operator could charge to an asset. You look for only maybe 4 to 5 ways that an operator, make money on the asset. Otherwise, you might be that the asset's kind of being feed to death in a way. But typically, there's going to be an acquisition fee, 1 to 3%. That keeps the lights on, right? For us, we look at 1,000 multifamily deals at a high level, underwrite about 500, do deep due diligence on about 100 properties, get 20 of them under contract, and we close on, say, like 10, right? That's what a typical funnel might look like. So that takes a lot of manpower, okay? So that acquisition fee helps kind of pay for all that manpower that, and the benefit to you is that you're not having to do it. Asset management fee, and this is going to be somebody managing the property management, okay, and taking a look at when is the right time to refinance, when is the right time to sell. That helps cover that expense. A capital event fee might be charged in order to help with any sort of refinance or restructuring debt, but also help cover the costs to put together the sale of the property. There might be some other fees charged, like if there's construction happening on the property, maybe a key partner or a guarantor has to be brought in to secure the loan. If somebody's guaranteeing millions and millions of dollars of their asset to secure the loan, that is the security you don't have to provide. There's oftentimes a fee to help cover that security. Most importantly, you want to make sure the fees are aligned with the actual business plan of the project. I've looked at offering memorandums before where there's a 10% construction fee being charged to the asset and there's no construction happening, right? You want to look for those different types of alignment. Another piece here on the due diligence, and we're getting really close to the end, guys, is making sure that the operator has filed, and you're not going to know it for this deal you're looking at, but previous deals, they're Edgar filings, okay, with the Securities and Exchange Commission. For most private placement deals, they're going to be filing a Regulation D exemption. They need to file it, okay? You can check the Edgar filings. It's really easy to do, but there's even a simpler website at formsd.com. It's the same thing, but you're only going to look at previous deals that operator's done. When your deal closes, you can then see the deal that you just invested in to see if they filed for that or not. And then also, I would just do a quick Google search, right before you write the check, on the operators, and check for any sort of legal filings or anything like that have cropped up, right? Again, you just want to make sure, again, that the operator is the one running the deal. They are your COO. You want to make sure that they are the person you want to hand your money over to. Okay. So also in here, we want to, again, just double check the capital stack on waterfall. Okay. What are the different layers of money that go into the deal? That's the capital stack. The waterfall is who gets paid when. Okay. Now they're different. So here's kind of a high level version of a capital stack, okay? The lowest risk position with the highest priority is going to be your senior debt. The highest risk position with the lowest priority payback should be the common equity or the general partnership position, okay? And sometimes the limited partner does share in the common equity position. This will be outlined in the PPM, so it's really important that you read the PPM to understand the fees, the business plan, as well as the waterfall, okay? Because that won't actually, oftentimes is not always in the offering memorandum. Now, what is it? I want to show you starkly the difference, okay? So this is a capital stack. This shows you the different layers of money. And then for us, the way we do it, this is the partnership structure. This shows you who gets paid when, okay? So that's why it's really important to be able to understand the two graphs and make sure both are present in any sort of offering memorandum that you're reviewing, okay? So, and this was, we already went through how to read. Somebody just asked a quick question, how do I read that? This is just a quick way how that capital stack read. The first hurdle on this was 7% preferred return, then split on the cash flow 70-30, and then on the membership side, it was 70-30 or 70% to the LP until they hit 13% IRR. And then after 13% IRR, they get 50-50, it splits 50-50 after. All right. So next steps for you guys, I'm going to clean up a lot of your questions here. I know some people have to go right at 12 o'clock. But when you go through all this due diligence, and it's due diligence. And I can tell you that majority of the people just, investors, they don't go to this level, but this is, really what due diligence looks like on real estate in general, but also on syndicated real estate. How do you do this and make it easy? It can be literally as creating a simple spreadsheet like this. Take a picture, right? And checking all these boxes, is this my ideal situation? If I'm looking at cash flow is ideal, or maybe it's good, or like, I don't really know. I need to ask some questions on what's going on here, right? Grade your assets that you're reviewing based on a checklist like this and see at the end, how many checks do I get in the ideal category, and what data do I need to ask the operator about, right? Just because it's not in the offering memorandum doesn't mean that, it can't be answered. A lot of times operators want you asking these questions so they can get to know you better as a partner. Data can also be buried in the investor webinar. So a lot of operators will put one out with the offering memorandum. Make sure that you review that. I love looking at the investment webinar and maybe putting it on 1.5x speed, just kind of speed it up a little bit. And again, if you have any questions of the operator, make sure you get answers and make a decision. And again, make sure that your expectations are adjusting with the type of asset you're going into, the asset class and business plan you're investing in, and then also the market cycle. Okay. Returns can kind of bounce all over the place, with, in response to these different variables. All right, guys, I gave you your action plan, but here's summing it up. Okay. Define your goals, understand your risk, vet your operator, vet your market, vet your deal, make a decision, go get into your deal. And this, you can find me at passiveinvestingwithwhitney.com. I should have like another, I'll post my email in the Q&A box or in the chat box here in a second. Okay. So a question came in, is the longer you're in a syndication, the lower the IRR? Let me see if I can get back to here. So if we're looking at the sensitivity stack or sensitivity analysis, okay, here, this IRR should, and if they said the whole time in this particular deal, we declared it was 5 years, this IRR should be at 5 years. Okay, if we sold earlier, say like in year 3, the IRR should go up. Yay, internal rate of return should go up. If we have to hold longer, more than likely the IRR will go down a little bit, okay? Because the IRR takes into account when you get your capital back, okay? Now, it will be different than the annualized return, okay? So hopefully that answered that question. Is it possible to do sensitivity analysis by factoring in rises in interest rates? There's no need to do that for 2 reasons. One, on this particular deal, there is no rise in interest rate. It's a fixed rate debt. Okay, so there's no need to do that. Okay, that expense isn't changing. Now, if an operator is using floating rate debt, their sensitivity analysis should be based on the highest cap. The cap that they purchased for this interest rate. That's the most conservative way to do it. So if you run across a deal that is using floating rate debt, that is a great question. You're going to want to ask, hey, was this analysis done, on the capped interest rate? Sarah, can you only progress the next phase evaluation? The prior phase passes your satisfaction. You can do it however you want. This is your process. I showed you mine. For me, if I, get overwhelming no's in phase 1, phase 2, screening phase 1, phase 2, I don't go on, right? So for me, I guess the question to ask is, does it matter what the lending is on the asset if it just isn't a deal that I'm interested in as far as like return profile and business risk? No. Okay, so this is meant to kind of, walk you through a way to save you time, save you headaches and heartaches, because now you have a checklist to look at and kind of grade. Now, we had somebody earlier that was like, this sounds like, this is too much, right? Like, this is a lot of factors to look at, and startup market might be easier for me to invest in. Guys, remember, I showed you it can be just as easy as filling out a little checklist just to make sure, like grading an asset A, B, C, or ideal good, ask more questions, okay? And just seeing which column do all those checks fall in, okay? Question, capital event fee. Yeah, capital event fee would be something like, sometimes operators charge a 1% fee to refinance, maybe do a supplemental loan, or to sell a property. So all of those are capital event issues, or not issues, but capital events. And so instead of saying 1% for this, 1% for that, 1% for to sell the property, they just say, hey, if we have a capital event, it's a 1% fee. What kind of Google search regarding local issues on the operator? I would, for me, I just look at, Google legal, and I look at the company, and then I also look at the managing partners, just to make sure that they're not getting ensnared in anything. More than, again, if you've vetted your operator very, very well, in the first stage here of due diligence, you're probably not going to uncover much. I just, look for, I just double check that because, I've invested in a couple of deals that there were cross collateralization of assets going on, and I wanted to see what was happening with other assets with the one and how it would impact the one that I was in. How do you build a real estate portfolio of multifamily syndications, asset class, location, fund versus single asset? Again, that's going to go to your goals and what you want to do. Okay, like I would go back to that boot camp that I did in September on goals and risks. That'll help you kind of understand from a high level what your goals are. Okay, what kind of risk you're willing to take on. Get those two questions answered first. As far as the mechanics of it, it's in finding which of those assets align with those goals and the risk profile you're willing to take, and deploying capital. Now, I think a lot of times when investors ask this question, they want to say, okay, if I were investing in the stock market, I'd put 60% in equities and 40% in bonds. That is going to be each individual preference. I have asked that question out of some of my mentors that are like professional passive investors and have been doing this for 20 years. And it's shocking how little of a weighting that they have. For me, we talked about what can you control? You can control the operator, the market, and the deal. Those are also the three different ways that you can diversify your portfolio: the operator, the market, and the deal. So it might be worthwhile to look at those three variables. And if your number one business risk is, the person who's is the operator, maybe, do find one stellar operator, do like 3 or 4 deals with them, and then introduce another operator that has a slightly different strategy, right? Now you're starting to expand your business a little bit. So that's kind of a way to look at that. For me, I like there's a pro and con to single asset versus funds. I'm going to do a masterclass on that because it's a little bit deeper of a conversation than we can go into right now. I personally like single asset deals or small portfolio deals where I can see the assets. I don't like blind funds unless I can come in at the end of the fund and see majority of the assets and the current performance. That's just me. I don't like blind funds. Now, blind funds tend to have greater incentivization. They get incentivized. Earlier investors come in. The earlier you come in, the more worthwhile that money is. And so operators will incentivize that money to come in early, in exchange for not seeing the assets. But for me, I'm pretty conservative. I love seeing assets, and I love small portfolios. Like our car wash deals are like right up my alley, because I can put down $100,000 and I got instant diversification over markets and deals. Boom, right there. So I really love that. Cool. Let's see. Is there a downside to investing in different deals with different operators? I do not wish to be married to one operator. No downside. I think typically what I see is investors try to work with multiple operators at one time, and they never really get to know one. So they get spread out too fast. I would look to, for me, like, maybe like like I said, do like 2, 3, 4. This is all personal preference with one operator, and then introduce another one. Or have 2 operators that have complementary strategy, and kind of go back and forth between them, and then add in a third one. But again, you're looking for people that are COO quality, okay, high quality operators. That's the most important thing here. June, you're more than welcome. Yes, I'm glad you enjoyed it. There will be a recording. Look for that in your inbox. It will be coming out later today or tomorrow. Is there a way you can quantify how much trust you place in the pro forma information? Oh my gosh. I don't have a quantification for that. I guess it's again, I'm a numbers person, so I kind of geek out about that. But part of that is coming down to really knowing the operator and asking questions of how did you get that number, and is that realistic to the market? And so if I'm kind of working with a new operator and it's a brand new market, and I just haven't wrapped my head around it. I know when I first started investing in Orlando, I did this because I saw a lot of build happening. I'm like, how is this operator saying this investment's conservative with all the supply, coming up around them? And I would ask them to pull CoStar data and show it, show me what they were looking at, build the case for me. And most operators are more than willing to do that. Can they do it on every deal for every investor? It might be a little bit of a lift and a challenge too, but especially if you're just building a relationship with somebody, and you've already done your own research, you just can't puzzle things together. Ask questions. That's what they're there for. Ask questions. Awesome. Let's see here. Is there a target investment amount that we prefer? So we have investment minimums, $75,000 to $100,000, depending on the type of deal. If you've got, something, if you have a question around what kind of investment level you want to come in at, just reach out to me at whitney@passiveinvesting.com, and let's have a conversation around it. Okay. Because I understand when people are new to an operator, they want to kind of kick the tires, and it's more than likely something that I can help you do. Oh, hold on. There's a lot of questions coming in really rapidly. I'm going to take just a couple more. When I have cash on the sidelines, would you advise that I pick up the best of currently open deals, or wait until I get an ideal deal? Ooh, that is forever the loaded question. It depends on what your goals are. I know that kind of sounds like kind of a cop-out. If you're looking for cash flow and equity, and you have time to wait, and you think that the market might give you another deal into the future, maybe it's best to wait. If you're kind of butting up against the end of the year, like I know a lot of people are right now, and you need tax benefits immediately in 2022, then you probably should be, shopping around amongst the current deals and see which one's the best for your portfolio. Okay, now I'm going to add on a blanket statement in there. Don't invest in a deal with a bad operator in a bad market just because you can get tax returns. Okay, and that's a horrible idea. But if it's a deal with an operator that you already know and love and trust in a market that you think is pretty cool and you might want to add to your portfolio, then maybe go for it. That would be kind of how I'd orient to that. It's hard to say. I've never had a deal come across my plate that checks every box in the ideal category. Never. It's never happened. There's always been something that I've had to kind of give on right now. And I shouldn't even say right now, but give on in general. So, but that's kind of how I orient to that. Hopefully that's helpful. I'm curious to hear your thoughts on using cash value from whole life on an investment vehicle for these deals. Seems like a no-brainer to me. Yeah, I do that. I love that. I do it all the time. It's a great way to kind of give an extra couple percentage points boost to your return. I guess the kind of asterisk on that, the caveat is like, do you have to pay back that loan? What's your interest rate on that loan? Or can you kind of like let it ride and let your let your cash value, or your insurance policy pay it off for you whenever you pass. For me, I'm constantly cycling money in and out of my policy all the time to acquire as much as I possibly can before 100% bonus or before bonus depreciation goes away. So I'm being pretty aggressive about it, but again, don't let the tax tail wag the dog on this. You want to make sure they're great quality investments with great quality operators. But yeah, I did a webinar with Chris Larson back in February. You can reach out to me at whitney@passiveinvesting.com and I can send you that link. But that would be a great, webinar to take a look at. Awesome. Oh my goodness. Let's see, 12:13. I was hoping to be done by 12:15 my time, and we got through all the questions. You guys have been amazing. Great questions. For those of you who are still here, I would love for you to reach out to me or even put in the Q&A box. What did you like about today's webinar? What could I have included that would have been more useful to you or of better use for you? What do you want to hear about in other boot camps? Again, boot camps give me the opportunity to kind of dig deeper with you guys, help you guys build systems for your investments. Right? The master class is like high level education. Here we can get down and dirty and actually build some systems. Oh, Jay, you're so sweet. Thank you. If you can't tell, I love real estate. I love passive real estate, especially the impact it can create for people. I would love nothing more if everybody could have like the life that we're living here. So, happy to pass it on. Awesome. Well, I'm going to hang out here just a little bit, let you guys post some Q&As. Otherwise, you guys have been amazing. And I look forward to doing another one with you guys soon. Yeah, Anish, you're so welcome. Happy to help. Yeah, Anish, go ahead and email me. That will be like my to-do list because I've already checked my inbox. I took a peek. It's really deep with follow-up emails, but email me and I'll send you that link. Otherwise, you can go to the YouTube page for the cash flow life insurance webinar and find the one that I did with Chris Larson last February. Otherwise, yeah, great. You email me. All right, you guys are very welcome. Have a fantastic day and we'll talk soon. Bye.